USDA Rural Development Loan. Hi, I'm Kevin Jefferson, the People's Lender, NMLS number 1433853. So today we're going to discuss a loan that has 0% down payment and 95% of America qualifies for it, meaning 95% of the land in America qualifies for it. But guess what? Not a lot of people are using it. So let's jump into it. So USDA, when you think of USDA, it's the United States Department of Agriculture. When I think of USDA, I typically think of meat, steaks, chicken, grade A beef. However, in this case, they have a rural development program, which allows for you to purchase homes where they guarantee it. And then they also mortgage one called direct. In this episode, we're going to talk specifically about the guarantee loan, which they back when lenders lend to them. So there's a 0% down payment out of pocket. You don't have to be a first-time home buyer. It can be a existing home, and they also have a program where you can build new construction. So USDA, you can get a single family home, no multifamilies. However, you can purchase a manufactured home, or some people call mobile homes. You can purchase modular homes, condos, and townhouses. So there's no seasoning, meaning with FHA, there's a 91-day rule. Seasoning rule where the owner of the property, if he or she flips a property, they have to have ownership in that property for 91 days before it can be financed. With USDA, it doesn't have that guideline, meaning if someone has a property that they purchased, it took them 60 days to renovate and put it on the market, and on the 65th day it went under contract, you can get USDA financing on that. So that's huge for someone who's looking for a home that may have come on the market. They can't go conventional, but they could potentially purchase with USDA financing. Now, what the important part about USDA, a key part about USDA is in a rural setting. So to USDA, a rural setting is defined as a city or town that has a population less than 35,000 people. So you don't have to buy a farm. It doesn't have to be a ton of land. However, it cannot be in a metropolitan area, and the population for that city or town cannot be above 35,000 people. So that's one of the qualifications. So not only will the borrower have to qualify for it, the home has to qualify, actually more so the home as well as the location of the home. Now, there's an easy way for you to find out if there is any USDA homes in your town, or if the home that you're interested in is USDA qualified. Below there will be a link where you can click on it, and it will allow for you to put in an address to see if it's USDA eligible right away. So the house has to qualify, location, as well as the borrower. So it has to be, of course, like I said, a primary residence, no investment property. So you cannot invest in properties using USDA funding with 0% down payment. It's specifically for home buyers. And again, you don't have to be a first-time home buyer. So in terms of applicants, the applicant has to, one of the key things for an applicant is they have to qualify income-wise. The applicant has to qualify, meaning their income cannot be over 115% of the area median income. If you need to find out what the area median income is for your area, there will also be a link below that will allow for you to ask you some questions, put in some information, and let you know what your area median income is and if you qualify for a loan through USDA. Key, not only is the income of the person on the application put into the equation, or on the loan put into the equation, it's anyone in the household. So example, if a husband is purchasing a home and he is the only one on the application and he's applying for USDA, they're going to ask for his wife's information, her income, to see if that puts them over the 115% of the area median income, or AMI. If you have a grandmother or someone in the house someone who gets Social Security, that income is included as well. So one of the cons to USDA is that it's household income and not just the income of the person on the application. In some cases, that doesn't hurt people. If you have a higher income or if your spouse has a higher income, that could hurt you for qualifying for USDA financing. So with USDA, if you are self-employed, they like to look at a 2-year history of self-employed income, meaning they'll take your last 2 years of tax returns and look at the income divided by 24 months to give you your factor of what your income, the average of what your income is. Now, USDA looks at W-2 employees differently. They want to see a 1-year history of income to make sure that your income is consistent from that point to today. However, one of the cons as well to USDA, and I'm not sure if you call it a con, with FHA, if you're not with some lenders with FHA, they don't require tax returns unless you're self-employed. With USDA, they require tax returns whether you're self-employed or not self-employed. So you want to make sure that you have your taxes done and readily available so you can give them to your lender. Yeah. So with USDA, they don't require a credit score. However, depending on which lender you have, they have something called overlays. Some lenders require 620, some require 640. If you're going to apply with a lender, you can find out, you want to ask them what is their credit score requirement for their USDA, even though USDA themselves do not have a credit score requirement. Another thing is USDA has low debt to income ratio factors, meaning they don't want the front end ratio to be higher than 29. What a front end ratio is your housing ratio. So your house payment cannot be more than 29% of your monthly income. And the back end ratio is total debt. So that's 41%, which means if you bring in $1,000 a month, your payments, including household payment, cannot exceed $410 a month. So for every $1,000 that you earn monthly, your expenses, including the housing debt, cannot exceed $410 a month of that. That's USDA's guideline. However, there is a caveat, meaning if USDA can go beyond the 29/41% debt to income ratio. However, they want to make sure that person has higher credit scores and a good credit history. So you want to make sure that if you are going to exceed it, you want to make sure you run it through GUS, which is the government underwriting system, which is where USDA has their own proprietary system where we input the data for the borrower into USDA system to see if we can get an approval. If we can get a GUS approval, then, and the underwriters can get GUS approval as well, when we ship that loan off to USDA for their underwriting of the file, they should be able to get a GUS approval as well, as long as we meet all of the criteria that they ask us for. If you have student loan debt, you'll definitely want to take a look at the video I did on USDA and student loan calculations. That will help you get an understanding of what type of payment plans and how much we utilize it and how we utilize the payment into the debt to income ratio. If you have any more questions, definitely comment below. Do us a huge favor, subscribe and give us a thumbs up if you enjoy the information. And if you scroll down, you'll see a link to a first-time home buyer's guide that will help you and walk you through some important steps on how to purchase a home and how to prepare to purchase a home. Once again, I'm Kevin Jefferson, the People's Lender. Have a great day.